I learned early in my career that the market punishes the man who thinks he has mastered his own mind before he truly has. I remember a campaign where I had correctly anticipated accumulation, but the moment price dipped a few points against me, fear whispered louder than logic, and I abandoned my position exactly where the composite operator wanted me shaken out. That single lapse cost me a move I had studied for weeks, not because my analysis was wrong, but because my discipline cracked at the slightest pressure. From that day forward, I understood psychological strength is not built in quiet moments. It's forged in the instant you feel fear tightening around your decisions and choose to act with intention instead of impulse. Every trader eventually discovers that the market is less a battlefield of prices and more a battlefield of emotions, and the one who cannot command his own mind is defeated long before he ever places an order. I learned this truth not from theory, but from the countless moments when I allowed a whisper of emotion to distort a clear plan. The tape would be telling one story: steady absorption, controlled reactions, narrowing spreads. Yet a sudden shakeout or a swift downtick would loosen my resolve, tempting me to abandon the structure I had read so carefully. What I came to understand is that discipline doesn't begin when you write a rule. It begins when you face the very moment your emotions demand you break it. Every surge of excitement, every flicker of doubt, every urge to act now before it's too late is merely the market testing whether you are guided by intention or by instinct. Once, during an accumulation campaign, I noticed a pattern developing over several days, the same operators quietly supporting the stock within a tight range, taking in shares with mechanical precision. My analysis was correct, my timing reasonable, and the logic sound. But on the third day, when an unexpected sell wave hit the tape, I felt a familiar tightening, anxiety disguised as prudence. Instead of observing how the stock behaved under pressure, instead of watching whether selling was absorbed or if supply truly overwhelmed demand, I cut my position. Minutes later, the same interests who had been accumulating stepped in aggressively, and the stock rose as if the sell-off had never occurred. My error was not analytical, it was emotional. I allowed a momentary tremor to overpower the structure I had already validated. That was the day I learned that discipline begins precisely where emotion ends, not before. True discipline in trading is not mechanical obedience to a set of rules. It is the ability to recognize when emotion attempts to override logic and to consciously choose structure instead of sensation. The market is designed to provoke reactions, rapid swings to ignite fear, sudden rallies to arouse greed, periods of stagnation to stir impatience. Every one of these moments is an invitation to abandon your principles. The undisciplined trader accepts that invitation again and again, surrendering his judgment to every twitch in price. The disciplined trader sees the same movements but interprets them differently, not as commands to act, but as signals to observe. He remains grounded in the broader campaign, the relationship between volume and spread, the character of buying and selling, the footprints of intent left by larger interests. Discipline becomes unbreakable when you stop treating emotion as an enemy and start treating it as information. Fear tells you where you are uncertain. Impatience tells you where you are unprepared. Greed tells you where you lack boundaries. Each feeling points toward a weakness that must be strengthened. When you meet those emotions with awareness instead of reaction, you transform the very impulses that once cost you profits into tools that refine your judgment. A trader who masters this internal struggle becomes difficult to shake out, impossible to lure into reckless trades, and naturally aligned with the true rhythm of the market. Prices may move sharply, news may stir the crowd, and volatility may strike without warning, but his decisions remain anchored. In that steadiness lies a quiet power, the kind of discipline that not only survives the market's turbulence, but uses it to thrive. A trader's first real loss has almost nothing to do with money. Long before a dollar leaves your account, the market takes something far more valuable: your composure. I learned this in the early days when I believed losses only occurred when the tape moved against me. Over time, I discovered that the true defeat happens inside the mind, often moments before the actual stop is ever touched. A shake in confidence, a sudden surge of fear, a creeping sense of uncertainty, these emotional fractures push a trader out of sound positions, distort clear analysis, and drive impulsive actions that never should have been taken. What the market extracts from you first is not capital but discipline, and once that is compromised, the financial loss becomes inevitable. Price movement merely completes the failure that began internally. I recall a campaign where I had done every bit of necessary work. The character of buying, the consistency of support, the drying up of supply, everything told me accumulation was underway. Yet each morning, as the stock hesitated within a tight range, doubts began to circulate in my mind. The small, insignificant reactions that should have meant nothing suddenly felt threatening. I was no longer reading the tape. I was reading my anxiety. When a mild downturn appeared, nothing more than routine testing, I allowed a wave of fear to convince me the entire structure had collapsed. I exited the position, and within an hour, the very interests guiding the campaign resumed their activity, lifting the stock with strength I had anticipated from the beginning. My loss wasn't the few points surrendered on the chart. My loss occurred the moment I surrendered my mental steadiness to emotion. Most traders think failure comes from misreading the market, but far more often it comes from misreading themselves. They believe they are reacting to price, when in truth they are reacting to fear, impatience, or ego. When a trader cannot distinguish between genuine market signals and emotional noise, his decisions become erratic. He cuts winners too soon because he is afraid to give back profit. He widens stops on losing positions because he cannot accept being wrong. He chases moves because he fears missing out, not because opportunity is present. Each of these choices drains mental capital, and once that reservoir is depleted, the trader becomes fragile, easily shaken, easily manipulated, easily misled by the very movements designed to test him. Protecting mental capital is more important than protecting financial capital because the latter is restored by opportunity, while the former is restored only by discipline. When your mind is steady, losses remain manageable, decisions remain consistent, and the structure of your analysis survives the stress of market fluctuations. When your mental foundation is cracked, even the best setups feel uncertain, and the slightest hint of volatility pushes you into errors you promised yourself you would never repeat. The strongest traders are not those who avoid losses, but those who refuse to let a loss begin in the mind. They treat every doubt, every emotional surge, every whisper of fear as a signal to reinforce their internal balance. They understand that the market can take their capital only if they first allow it to take their clarity. By protecting that clarity, they preserve the one advantage that separates professionals from the crowd, the ability to act with intention while others are ruled by emotion. Every period of pressure in the market reveals the truth about a trader's preparation. It is easy to believe you are disciplined when prices move smoothly in your favor, when volume behaves exactly as expected, and when the crowd is calm. But the market rarely rewards comfort for long. Instead, it introduces disorder, sharp shakeouts, sudden news, unexpected surges in volume, and movements designed to test every assumption you have made. In these moments, a trader learns whether his analysis was built on genuine understanding or merely on hope. The tape does not lie. It exposes the weak, rewards the prepared, and punishes anyone who mistakes optimism for structure. I learned this repeatedly in the early years when I believed conviction alone could protect a position. It never did. Only preparation could. There was a campaign I studied where accumulation had been evident for days. The operators had held price within a narrow range, supply was drying up, and reactions grew lighter each session. My notes were thorough. My read was sound. Yet when a violent shakeout struck one afternoon, a deliberate move meant to unsettle the unprepared, I felt uncertainty ripple through me. My mind scrambled for explanations rather than observing the character of the movement. Instead of analyzing whether the selling was genuine or simply a test, I allowed the suddenness of the drop to override the weeks of preparation I had done. I exited the position, convinced the structure had failed. Within minutes, the stock reversed sharply, closing even stronger than before. My analysis had not failed. My preparation had. I had prepared for the trend, but not for the test. Market pressure highlights this difference with perfect clarity. A trader who is deeply prepared sees turbulence not as a threat, but as information. He studies whether volume expands or contracts during the reaction, whether spreads widen or narrow, whether selling appears aggressive or merely opportunistic. He looks beyond the surface to understand intention. The unprepared trader, however, sees the same movement and interprets it emotionally. A sudden drop becomes a sign of danger, not a test of supply. A quick rally feels like a missed opportunity rather than a probe for demand. Without preparation, the mind seeks immediate relief from discomfort, and that impulse leads to premature exits, impulsive entries, and decisions that make sense only in hindsight. True preparation in trading is more than studying charts or reading tape patterns. It means understanding the full campaign, how accumulation behaves under stress, how distribution disguises itself, how operators create volatility to separate informed traders from weak holders. It means rehearsing scenarios mentally, committing to rules that hold up under pressure, and knowing the context so thoroughly that temporary noise cannot distort your judgment. When you have prepared at this level, every test the market throws at you becomes an opportunity to confirm your read rather than question it. The market will always manufacture pressure. It is part of its design, forced reactions, emotional swings, and movements intended to disguise true intent. The trader who is prepared meets these moments with clarity, while the unprepared meet them with fear. And in that difference lies the entire outcome of a campaign. When pressure arrives, the trader's work is revealed. Either he stands firm, aligned with the structure he understands, or he is swept away by movements he never took the time to anticipate. Consistency in trading has very little to do with talent and everything to do with ritual. The market rewards those who bring the same level of preparation, discipline, and clarity to every session, not just when they feel inspired or when conditions look ideal. In my early years, I believed success came from sharp instincts and strong conviction. I quickly learned that instinct without structure leads to inconsistency, and conviction without routine leads to ruin. What steadies a trader is not motivation, but the daily habits that anchor his mind before the market has a chance to unbalance it. The traders who last are the ones who treat preparation as a non-negotiable duty, not an optional task to be completed when convenient. I recall a period when I was experiencing a series of successful trades. Confidence had grown, perhaps too much, and I allowed routine to slip. I skimmed the tape instead of studying it. I reviewed levels casually instead of documenting them with precision. I entered the session believing that recent success meant future success was guaranteed. Then came a day when the market behaved differently. Volume swelled unexpectedly, price whipped back and forth, and the clear signals I had grown accustomed to faded into noise. Because I had abandoned my rituals, I approached the session unprepared and unfocused. I chased a move that didn't deserve pursuit, hesitated where decisiveness was required, and doubted my analysis at the exact moment the tape demanded clarity. The losses that followed were not due to misreading the market, but due to failing to build the mental consistency that routine provides. A disciplined trader understands that the market is indifferent to his emotions. It does not care if he feels confident, uncertain, tired, or inspired. It moves according to its own structure, and the only way to meet that structure with accuracy is through habits that reinforce mental sharpness. Pre-market preparation, for instance, is not merely a review of charts, it is a process of clearing emotional residue from the mind. Studying key levels, understanding the broader context, reviewing previous sessions, all of these steps place the trader in a state where reactions are grounded in analysis rather than in impulse. When this becomes a daily ritual, the mind meets the market with steadiness instead of tension. Journaling trades is another essential ritual, though many neglect it. The act of writing forces clarity. It requires honesty. It exposes patterns of weakness and confirms patterns of strength. The trader who journals consistently is less likely to repeat mistakes because he confronts them on paper. The one who does not is doomed to relive them in the market. Over time, these written reflections become a map of personal tendencies: fear, impatience, overconfidence, and the trader who studies them gains insight into himself that no chart can provide. Risk parameters, too, become part of ritual. A trader who sets limits before the session begins acts with intention. A trader who makes decisions in the heat of the moment acts with emotion. Rituals remove the need for emotional decision-making. They transform trading from a reactive endeavor into a structured process, reducing the chaos that consumes so many. Consistency comes not from waiting for ideal conditions, but from preparing so thoroughly that conditions matter far less. When a trader relies on ritual rather than on mood, his decisions become steady, his reactions measured, and his performance reliable. The market's uncertainty remains, but his behavior becomes predictable, and in that predictability lies the true strength of a professional. One of the most difficult truths a trader must accept is that the most profitable action in the market is often the act of doing nothing. It feels unnatural. Every instinct urges movement: enter, exit, adjust, intervene. The crowd thrives on motion, it craves constant participation. Yet the market rewards the trader who can resist that pull and remain still until true opportunity emerges. I learned this lesson through countless campaigns where the greatest gains were not made through aggressive action, but through the patience to wait while others exhausted themselves in noise. Sitting idle while the market tempts you requires a strength far greater than the strength required to take a trade. It demands confidence in your preparation, trust in your analysis, and the humility to acknowledge that the market, not your impulses, sets the timetable. There was a campaign I studied early in my career where I anticipated a substantial advance. The structure was forming clearly: quiet accumulation, deliberate support, and a drying up of supply. Yet the move did not begin when I expected. Days passed with the stock drifting aimlessly, spreads tightening to a whisper, and volume shrinking until it felt as though no one cared about the issue at all. The inaction gnawed at me. I felt compelled to do something, to take a smaller trade, to adjust my position, to find action elsewhere. And on one of those restless mornings, impatience outweighed discipline. I exited the position, convinced the campaign had lost momentum. Within 24 hours, the advance began with such force that the entire market noticed. The operators had simply waited for the right moment. I had not. The market is engineered to exhaust the impatient. It creates stretches of dullness where nothing seems to happen, not because opportunity is gone, but because opportunity is being prepared. These quiet periods test a trader's resolve far more than volatile days. Volatility is easy to respect, boredom is not. When nothing happens, the mind invents doubt. It seeks stimulation. It convinces you that inactivity is weakness, when, in truth, inactivity is often the greatest display of strength. The trader who mistakes stillness for stagnation continually forces trades where none exist, losing capital and clarity. Doing nothing when nothing should be done is not passivity, it is selective participation. It means choosing only to engage when the market reveals intention, when the footprints of larger interests become visible, when price and volume confirm readiness. It means understanding that the market offers only a handful of meaningful opportunities in any campaign, and everything in between is merely noise designed to shake loose the undisciplined. This restraint is what separates the professional from the public. The public chases movement, the professional waits for structure. The public trades out of restlessness, the professional trades out of alignment. When restraint becomes instinct, a trader stops battling the market and begins working with it. He no longer wastes energy fighting noise or reacting to random swings. His focus sharpens, his capital is preserved, and his judgment is reserved for moments that matter. Unbreakable discipline is forged not in the trades you take, but in the ones you refuse. When you master the art of waiting, truly waiting, you gain the one advantage the market cannot manipulate, the ability to act only when the odds are decisively in your favor. In the end, every trader discovers that the market's greatest battles are never waged on the chart. They are fought in the quiet spaces within the mind. Discipline is not a single habit, but a constellation of behaviors forged through struggle, the ability to separate emotion from decision, the awareness that mental weakness always precedes financial loss, the preparation that steadies judgment under pressure, the rituals that create consistency, and the patience to remain still while the crowd exhausts itself in noise. Each principle strengthens the others. When emotion fades, clarity rises. When clarity holds firm, pressure becomes information. When preparation is complete, ritual becomes routine. And when routine is respected, restraint becomes effortless. A trader shaped by these qualities stands apart from the crowd, not because he is smarter or faster, but because he refuses to be ruled by the impulses that destroy so many. He acts with intention, waits with purpose, and trusts the rhythm of the market more than the turmoil of his own feelings. This is how true psychological discipline is built, not through occasional strength, but through unwavering steadiness, day after day, test after test, until nothing in the market can shake the foundation you have constructed within yourself.